It's Sunday, the 22nd of July, 2018. It's been an interesting couple of weeks in the gold market and in some of the wider markets as well. So I thought I'd do a video and try and get through quite a few charts. First off, the gold price. Obviously, it's been very weak for the last couple of months now, coming back down from that 1350 sort of 1350, 1400 resistance zone that's been holding for the last 5 years. It's broken down below this lower trend line. I'm not a huge believer necessarily in these trend lines, and this meaning a full breakdown. Gold does have a habit of breaking below trend lines and taking out stops. So whether that's an imminent indicator, I mean I'm looking at this 1200 level, as I've mentioned before, as my sort of if it breaks 1200, I would consider it. This bull move is now over, and I'd expect sort of lower prices for maybe an extended period of 6 to 12 months. And I've been hedging some of my positions in stocks in the last couple of weeks, just in case that is the case. But it did have a nice little reversal on Thursday and Friday. Came up from that sort of 1210, 1215 level and closed on the highs of about 1232, and that's not a bad move. That sort of 3-day reversal is a bit of a something you tend to see at bottoms with those large long wicks on the candles there. So there's some potential there. Maybe it comes back up and tries to test that break of the trend line. If it is a full breakdown, it will come up and test it and then fall back. So if that happens, it might be a cue to sell some of the positions for gold traders and for longer term weakness. But I'm still cautiously optimistic here. But you got to start. I've started to hedge some of my portfolio there just a little bit. Some of those more speculative positions. The US dollar index is probably the one that I'm most interested in. I've got a couple of things here. US dollar index chart. I've been talking about this range around this sort of 93, 94, 95 zone, and that when that broke in late 2017, that was always there's very likely that it would come back up and test that zone, considering how much of a support zone it was in 2015, 2016 after that big bull move from lows around 80 up to 105 sort of levels. 103 I think was the top. So now it's come back into this zone, and it's really been struggling to break through that 95 level. And when I see that, I don't think there's quite a lot of weakness. If I can just get the most recent, so big down day on Friday. I think that was the weakest day for the dollar index in a couple of months, and probably one of the weakest days this year. And for it to be struggling again at 95, it looks like it could be forming a kind of a triple top here. There's definitely some heavy resistance at that level, and that's one of the reasons why I think gold might, US dollar gold anyway, might start to have a little bit of a bounce here. One scenario I spoke of in a previous video of the dollar index, I think, was for it to really sort of come back down and potentially try and form a shoulder here around this. If you could say this was going to be an inverse head and shoulders pattern, so that's a shoulder there, head here, come back, try and form another shoulder. So it might pull back to this sort of 91, 92 level in line with the sort of the numbers here. So that's just my, purely from a visual perspective, often these charts seem to form those similar sort of patterns. But, with it trailing, we've been up at these levels now for almost 2 months. It's been trying to poke above 95 and it's struggled. And when charts tend to do that, I think lower prices are likely here, and I think it's going to break down this below this 93 level, and that should be that would correspond with the gold rally of maybe another $30 or $50, and trying to probably get back up to that trend line I was speaking about on the gold chart. A couple of other things. Might look at the stock charts of the ETFs. The GDXJ and the GDX have really failed to confirm sort of this breakdown in gold, which is another reason why I'm still relatively bullish here. Normally, if gold has moved down $150, or maybe not, it's almost $130 to $150 from the highs sort of 2 or 3 months ago, you'd expect this GDX chart to have really fallen apart, and it hasn't happened. And it's probably it's a little bit of weakness here in the last couple of months, but it's down maybe 3 to 5%. Yeah, maybe a little bit more than that, 5-7% from April. So that's not showing that there's major breakdown here. And often the gold mining stocks tend to lead the indices, lead the gold price. So the GDXJ is pretty similar, holding above this, above the support level that's been in since mid last year. After that, I think that was probably after the GDXJ rebalance event, and that's been holding there for a year now, and around that 30 as support. So it's not really showing any major breakdown. The GDXJ is probably even stronger than the GDX chart, to be honest. And I mean, fundamentally, a lot of these gold miners are in a really good position relative to where they were, say, 3 or 4 years ago. They've paid down a lot of debt. Their operations are doing okay. So they're printing out cash flow more than they were a few years ago, even with higher gold prices. So they're doing reasonably well. So you wouldn't expect, maybe that's the reason that you're starting to see this divergence here. I was starting to looking at the couple of the I've shown these before, but I look at these fund flow charts for the GDX and the GDXJ as well, and you can see in the last 6 weeks or so, with that weakness in the gold price, you've seen good fund flows into the GDX still. So you've probably seen another 3 to maybe 500 million or more US dollars flowing into that, and even since the start of this year, it's 1.2 billion into the GDX ETF, and another 600 million into the GDXJ. So there's still pretty good money coming into those funds at a time of gold price weakness. So something doesn't quite make sense there, and maybe it's that maybe that money's starting to see the fundamentals of these companies are actually quite good. So that's something I'm watching at the moment, and one of the reasons why I'm not super bearish on the gold price, even though it has broken that trend line level. The S&P 500 chart has continued to sort of try and get above that breakdown in early February, and struggling to do so. And I think now it's really reached a kind of a key level here, where you see those high volume days in late January, early February there, and it's back up at that level around that 28.20 to 28 sort of 50, and that's now it's really need to break higher, and it doesn't look like it's going to be honest. It's starting to roll over. It's some of the constituent stocks, which I'll talk about in a minute, are starting to struggle a little as well. And this, again, I've talked about this probably, I don't know, 5 or 6 times this year in these videos. This S&P .com bubble peak took 6 to 9 months to play out after it peaked in March 2000, and then wasn't until the end of the US summer that it kind of rolled over. And that's been my base case since about March, looking at this chart, and I think still quite possibly we might have another month or two in it, but I still think this is going to roll over in the back half of this year. So that's been my base case, and I think there's nothing in this chart to suggest that we've got new highs coming in anytime soon. I thought one of the interesting things this week was the Netflix earnings came out. I don't know about earnings, but subscriber numbers anyway, and they were weaker than expected. I talked about this stock probably when it was at 300, and talked about how it was incredibly overvalued, and was probably, I think, might be the poster child for this little tech bubble in maybe in 10 or 20 years. People talk about Netflix's stock price in the same way they talk about Cisco, which is one of the biggest movers in the .com bubble. Netflix stock is up, had doubled in the last 6 months. And I think the key here is when these expectations get really high and they can't deliver, and you see that's huge sell-off there on the earnings. Subscriber numbers were weaker than expected. I think they didn't add as many subscribers, and people use that as sort of the proxy for how well the company's performing. It's still trying to buy the dip there, but then it's continued weakness. So I think this is probably going to head lower. Netflix is not a huge component, but when we talk about, this is something I saw on Twitter this week. This is not a bad little feed to follow, and You can see here, this is the FAANG, the Facebook, Amazon, Netflix, Google, an unweighted index versus sort of FAANG and a few other of the tech names. And you can see here there's sort of a divergence between those other tech names and those original FAANG names, suggesting that sort of even the breadth in the market is tightening even more so. I mean, it's been a few sort of tech stocks been pushing international markets up still. I mean, some of these are actually Chinese stocks, Alibaba in there, and but it's even they're starting to struggle in the last few months, and it's been those original ones that are pushing it up higher. So it's sort of the breadth within the breadth is the breadth within those FANG names, and FANG Plus is getting even lower. So that's another sort of bit of a warning sign there. I think Amazon's earnings are coming out soon as well, so that stock's up, I think, probably about 80% in the last 12 months. So you got to be careful here. Like, I think a lot of people are playing with fire in these big names, that they could quite easily come back. And if I can bring it up there, not popping up. So yeah, I'm just a bit cautious that that's a bit Italian version, but you can see here similar sort of thing. It's up 60-70% this year. So I'd be very cautious holding that ahead of some of these earnings. Usually these stocks have outperformed, but at some point they won't. And Netflix had outperformed probably for the last 12 months in its earnings calls, and then it didn't, and then its stock's down 15-20% in a day. So you've got to be a bit careful there. Australian dollar, interesting one as well. Actually, I'll look at the Australian gold chart. That's broken down below this key trend line as well. And a lot of the sentiment in the gold sector actually reminds me of late 2016 after Trump's victory. And that was sort of this period here. And I think at that time, and probably the last 3 or 4 years, I've talked about this 1650 level being a bit of a key bullish bearish case for gold stocks, Australian gold stocks, and it's still holding above that. There's no particular reason why that support resistance. I just found it to be the level that it held in maybe this 2015, 16 period as a bit of a pivot point for the market. So we've broken down below this trend. We broke down below it mid last year as well, and then it came back in. So I wouldn't be surprised if we regain that trend again. This is my sort of long-term base case for gold price, the Australian dollar gold price going up toward that sort of 2,000 probably in another 12 months time within that sort of period. So, I still think that's possible. The Australian dollar itself, which is what I was trying to bring up before, still looking pretty weak. A bit of a kind of a bear flag forming again, not regaining anywhere. Could say that's a bit of a bottom here. There was some relatively strong job numbers this week, or perceived as strong, but I really don't know if the market cares about the jobs numbers too much. With all that China trade news in the market as well, I think that's inevitably going to be bad for the Australian dollar. It hasn't been so bad yet, but I think the rhetoric there, Trump's sort of ramping up, and the Chinese retaliation to this point has been, they've kind of been just sitting and waiting. But I think if they do retaliate in any significant way, that could be really when the Australian dollar starts to tank again. So that is still in the market. I think in the next month we're going to start to see some of that retaliation if Trump keeps ramping it up, and I think there's a lot of downside risk in the Australian dollar there. The ASX 200 chart's been pretty good as well the last few weeks. I've been a skeptic on this chart, and I don't have any exposure to the ASX 200 and haven't for quite some time, but it has performed very well. And I think, earlier this year, I think a lot of that was probably due to the rally in materials stocks, particularly probably in this April-May period was when, some of the bigger names in the materials sector like BHP were starting to rally, and Rio as well. And the oil stocks are doing quite well. And I think that's in the last couple of weeks, it's actually been a bit of a worry how the market's been outperforming, but for no real fundamental reasons. Those bigger names in the material sectors have actually been, sideways at best. And it's actually been the bank stocks and some of the, domestic sort of focused companies, like Woolworths and Wesfarmers as well have actually been outperforming. And from my mind, there's no real reason for that, for their stocks to be outperforming. There's no major fundamental news come out. The economy's not suddenly performing better. So that's a sort of, when you start to see the underlying strength in the market is in the sectors that probably shouldn't be, and that's starting to worry me. Um, so it's performed well. I think in the last video I talked about when it broke above that 6150 kind of level, you could kind of see a 6400 was possible if you're sort of saying this was a kind of a double bottom here, with the the breakout level around that level, that 6150. So 6400 still looks like it could be possible here, and I remain skeptical. I'll look at some of those. If you look at the actual the materials sector, which is about a 15% weighting. I think I had it actually here. I had the weightings. This might be a little bit out of it. So it's about 18% weighting there. The it's actually been sideways since mid-May, while the ASX 200 is up about 10%. It's really been the financials, so the banks that have pushed the index up. As you can see there, the financials index is up about almost 10% in the last month. So that's nothing's really changed in those stocks from what I can see. Probably some of the stuff with the Royal Commission and whatever has been a little bit subdued compared to where it was maybe 2 or 3 months ago. There hasn't been any of those sort of daily stories of the banks being in regulatory trouble. So I think that's quietened down a little bit, but it hasn't gone away. And I think some of the fallout of those, that Royal Commission will start to affect the bank sector earnings and stuff. So that's, you need to, I think people are starting to forget about this. So I'm not really sure what's driving the market up higher in the last few weeks, other than those financials. I think the healthcare sector. I had a look at the Wesfarmers chart and the Woolworths chart as well, just before, and Wesfarmers is up sort of 20% in the last 2 months. So I'm not sure what's driving that. Interestingly, I looked back at the 2006, 2007, had a similar move where it was sideways for a long time and then broke out in a straight line above the previous kind of high there, and that was just before the market started to turn over. So I'm not entirely sure what's driving this move here, but Woolworths has had something quite similar. And when you see these sort of consumer staples stocks really starting to move higher on nothing really. I mean, Woolworths is trading right up to the level at where it broke down from a couple of years ago, when everyone was worried about other supermarkets coming into the market and compressing Woolworths margins and putting them under pressure. And I don't know why that some of those fundamental stories still exist. That's still the case that Woolworths might be in trouble from overseas supermarket players coming here and taking some of their market share, and them and Woolworths having to compete for that market more strongly. So that's when stocks have these rallies and people start to forget about that underlying story that I don't think has gone away. Then you need to sort of question why the market's doing that. And I think it's really just money flow at the moment pushing some of these stocks higher. But Woolworths there, I wouldn't be buying it. Definitely wouldn't be a buyer at Woolworths stock at this stage. Not that I ever have been, but it really looks to have at a key sort of resistance level there. There was a huge couple of volume days there. Yeah, the highest on this chart, the highest in 8-9 years. So you got to wonder whether those companies can really push a lot higher. So that, I guess my point is, ASX 200 still looks to be trying to eke out gains, but I'm not very bullish on its prospects. And I think when some of the mining stocks start to deteriorate, that might start to pull the index lower. And I think in general, if the sentiment in the trade war kind of stuff, that will start to affect the Australian share market a bit more strongly in the coming weeks. So we're kind of levitating here relative to some of these other world markets, particularly the Chinese market. Chinese stock market's down heavily in the last few weeks. So I'd be very cautious as a buyer buying the ASX 200 here. and I think there's a lot of risk to the downside over the next few months. But anyway, it is what it is, and it'll keep doing what it's doing. So all in all, that's a fairly long summary of some of these major markets. Um, I think US dollar index is at a key turning point, and hopefully that might be a bit of have a bit of an effect on the gold price as well in the short term. And I think that you've got to watch out for some of that trade news and potential Chinese retaliation into other things that could affect the US. Maybe something to do with US treasuries or something like that. That's always sort of a gold bug's dream to hear something about a story about China dumping US treasuries heavily. But I think something like that is on the cards potentially in the next month as Trump tries to find out how China will retaliate, and I think they will. So happy trading for the next couple of weeks.